In the world of economics and finance, the phrase housing crash sends shivers down the spines of both investors and homeowners. It evokes memories of the devastating 2008 financial crisis that crippled the global economy. However, as we peer into the near future, ominous signs are pointing to a housing market downturn that could surpass even the dark days of 2008. To truly understand the gravity of the situation, we must rewind the clock to 1988. A year that holds eerie parallels to today's housing market, offering insights into the impending storm. Before delving into the potential housing crash of the near future, let's reflect on the traumatic events of 2008. The collapse of Lehman Brothers, a major Wall Street bank, served as the catalyst for a chain reaction that led to a global financial meltdown. The housing market was at the epicenter of this crisis, with millions of homeowners losing their homes, plummeting property values, and a wave of foreclosures that washed over the nation. One of the key drivers of the 2008 housing crash was the subprime mortgage crisis, in which lenders extended home loans to borrowers with poor credit histories, often with adjustable interest rates that ballooned over time. As these borrowers struggled to meet their monthly payments, a wave of foreclosures ensued, flooding the housing market with an oversupply of homes. Property values plummeted, causing homeowners to lose equity and, in many cases, face foreclosure. While the 2008 housing crash left a searing imprint on our collective memory, the lessons of an earlier crisis in 1988 have largely faded into obscurity. The events of that year, however, are eerily reminiscent of today's housing market, and they offer a stark warning of the potential magnitude of the impending crash. In 1988, the United States was experiencing an unprecedented housing boom. Home prices were skyrocketing, and speculation ran rampant. This period of exuberance was fueled by easy access to credit, much like the lax lending standards that precipitated the 2008 crisis. Low interest rates, relaxed lending criteria, and an insatiable appetite for real estate investments set the stage for a housing bubble that would ultimately burst with devastating consequences. Fast forward to the present day, and we find ourselves in a strikingly similar scenario. The housing market is once again riding a wave of optimism, but underneath the surface, there are unmistakable signs of trouble. To understand why the upcoming housing crash has the potential to be worse than 2008, we must examine the striking parallels between the present moment and the events of 1988. One of the most alarming parallels between 1988 and today is the meteoric rise in home prices. Across the United States, housing markets are experiencing double-digit price increases, reminiscent of the speculative frenzy that preceded the crash in 1988. As in 1988, many potential buyers are finding themselves priced out of the market, raising concerns about the sustainability of these inflated values. Just as in 1988, easy access to credit is a driving force behind the current housing market surge. Low interest rates and lenient lending standards have made it possible for a broader swath of the population to qualify for mortgages. While this has boosted demand for homes, it has also raised concerns about the quality of loans being extended. Subprime mortgages, which played a pivotal role in the 2008 crash, are making a comeback, fueling fears of a repeat performance. Investor speculation in the housing market is another cause for concern. In 1988, real estate investors played a significant role in driving up property prices. Today, a similar scenario is unfolding, with institutional investors and individuals alike pouring money into real estate in the hopes of making quick profits. This speculative activity can create artificial demand and contribute to unsustainable price increases. Another striking similarity between 1988 and the present day is the shortage of available housing inventory. In 1988, a shortage of new construction contributed to rising home prices. Today, a combination of factors, including supply chain disruptions and labor shortages, has led to a scarcity of homes on the market. This imbalance between supply and demand has driven prices higher and left many potential buyers struggling to find affordable housing. The return of risky mortgage products is perhaps the most troubling parallel between today and the events of 1988. Just as in the lead-up to the 2008 crisis, lenders are once again extending mortgages with adjustable interest rates, interest-only payments, and low down payments. These products may initially make homeownership seem more accessible, but they also increase the risk of default when interest rates rise or home prices falter. When we combine these factors, skyrocketing home prices, easy access to credit, speculation, supply constraints, and risky mortgage products, we create a perfect storm in the housing market. This storm, brewing on the horizon, has the potential to make the 2008 housing crash look like a mere tremor in comparison. One of the looming threats to the housing market is the inevitability of rising interest rates. The Federal Reserve has kept interest rates historically low in response to the economic challenges posed by the COVID-19 pandemic. However, as the economy recovers, the Fed is likely to begin raising rates to combat inflation. When this happens, borrowers with adjustable rate mortgages and those reliant on low interest rates may find themselves struggling to make higher monthly payments, leading to increased defaults and foreclosures. The rapid increase in home prices has made homeownership an elusive dream for many Americans. This growing unaffordability is contributing to income disparity and social inequality. It's not just about buying a home. It's about securing a stable future and accumulating wealth through real estate. As more individuals and families are priced out of the market, the social and economic consequences could be severe. The financial system today is more interconnected and complex than it was in 1988 or even 2008. The proliferation of complex financial instruments and the interconnectedness of global financial markets have the potential to magnify the impact of a housing market crash. The risks associated with mortgage-backed securities, derivatives, and other financial products could pose systemic threats, affecting not only homeowners but also investors, banks, and financial institutions worldwide. A housing market crash is not confined to the real estate sector. It has far-reaching economic implications. The construction industry, which plays a vital role in the broader economy, could suffer significant job losses. Consumer spending may decline as homeowners grapple with declining home values and higher mortgage payments. The ripple effects can extend to other sectors, potentially triggering a recession or economic downturn. Perhaps the most unsettling aspect of the impending housing crash is that it appears to be unfolding despite the painful lessons of 2008. The regulatory reforms and safeguards put in place after the last crisis were intended to prevent a repeat occurrence. However, as we've seen, financial institutions are once again engaging in risky lending practices, and oversight may not be as robust as it should be. As we peer into the uncertain future, the specter of a housing crash looms large. The parallels between today's housing market and the events of 1988 are too striking to ignore, and the consequences of a crash could surpass even the painful memories of 2008. To weather this impending storm, individuals, policymakers, and financial institutions must heed the warning signs and take proactive measures. For homeowners, it's essential to evaluate the sustainability of their mortgages and consider refinancing into fixed-rate loans to shield themselves from rising interest rates. Prospective buyers should exercise caution, avoiding risky mortgage products, and only entering the market when they can comfortably afford a home. Policymakers must closely monitor the housing market and be prepared to implement safeguards to protect against reckless lending practices and speculative bubbles. Strengthening regulations and oversight is critical to prevent a repeat of the mistakes that led to the 2008 crisis. Financial institutions, too, must exercise prudence in their lending practices and consider the broader implications of a housing market crash. Mitigating risk and diversifying portfolios can help shield them from the fallout of a potential crisis. In the face of an impending housing crash that could surpass the devastation of 2008, the lessons of history must not be forgotten. It is only through foresight, responsible decision-making, and a commitment to financial stability that we can hope to navigate the storm on the horizon and emerge on the other side with our homes and our economy intact. Thank you for sticking with me all the way to the end. Please like, comment, and subscribe, and make sure the notification bell is turned on so you don't miss a video.